September 2008. Lehman Brothers collapses. The global financial system teeters on the edge of oblivion. You watched your parents' retirement accounts evaporate. You heard about the bailouts, the too big to fail banks, the foreclosures that ripped through your neighborhood like a plague. But here's what they didn't tell you. The collapse wasn't a failure of the system. It was the system working exactly as designed. What if I told you that the 2008 financial crisis wasn't an accident, but the culmination of a decades-long scheme to transfer wealth from the middle class to the financial elite using weapons you've never even heard of? What if the foreclosure on your neighbor's house, the layoff at your dad's factory, the inflation eating your paycheck today? What if all of it traces back to a single deliberate architectural choice made in the shadows of Washington and Wall Street? Before we go further, drop a comment and tell me where you're watching from. This isn't just another finance video. This is the unfiltered truth they buried under complexity. If you're tired of being lied to, hit that subscribe button. Because by the end of this video, you're going to see the American economy the way the elites see it. As a casino where they own the house, and you just another chip on the table. Let's rewind. 1999. The Gramm-Leach-Bliley Act officially repeals the Glass-Steagall Act, the Depression-era law that kept your savings banks separate from Wall Street's gambling den. For 66 years, Glass-Steagall was the firewall. Banks that took your deposits couldn't gamble with them in the stock market. Investment banks that made high-risk bets couldn't raid your checking account when those bets went south. But by 1999, that firewall was rubble. Citigroup had already merged with Travelers Group a year earlier, creating the largest financial supermarket in history. Technically illegal, but who's counting? The repeal just made it official. Commercial banks, investment banks, insurance companies, all one giant, interconnected house of cards. Sound familiar? Because today, in 2025, your bank isn't just a bank. JP Morgan Chase holds $3.4 trillion in assets. It's a commercial bank, an investment bank, a hedge fund, a private equity firm. It trades derivatives, underwrites bonds, manages wealth, and holds your mortgage. When it wins, executives get bonuses. When it loses, you get the bill. The 1920s saw the same setup. Banks loaned money to speculators who bought stocks on margin. When the market crashed in 1929, those banks collapsed, taking the entire economy with them. Glass-Steagall was the response. Never again, they said. But by 1999, the financial lobby had spent decades chipping away at it, whispering in the ears of politicians that the old rules were outdated, that America needed competitive banks to dominate the global market. Sound familiar? Because that's the exact language used today to defend private equity's takeover of healthcare, housing, and utilities. Innovation, efficiency, competitiveness. The words change. The scam stays the same. Here's where it gets darker. The repeal of Glass-Steagall didn't just allow banks to gamble. It allowed them to gamble with leverage they didn't have, using financial instruments you couldn't see, in markets you didn't know existed. Enter the shadow banking system, a parallel financial universe operating outside traditional regulations, where banks could take massive risks without reporting them, where your mortgage could be sliced, diced, repackaged, and sold 20 times over before you made your first payment. By 2007, the shadow banking system held $20 trillion in assets. For context, that was larger than the entire traditional banking system. Hedge funds, private equity firms, money market funds, investment banks, all operating in the dark, all interconnected through a spiderweb of derivatives so complex that even the people trading them didn't fully understand them. Sound familiar? Because today, the shadow banking system is bigger than ever. By some estimates, it's $200 trillion globally. That's more than twice the entire world economy. Your 401k, your pension, your mortgage, all of it flows through this system. And when it collapses again, and it will, the damage will make 2008 look like a practice run. But the real genius of the scheme wasn't just allowing the gambling. It was making the gambling seem safe. Here's the mechanism they never explained in your economics class: derivatives. Specifically, credit default swaps and collateralized debt obligations. These aren't just fancy terms. They're financial weapons of mass destruction, and they were designed to do exactly what they did in 2008. A collateralized debt obligation, or CDO, is a bundle of mortgages, thousands of them, packaged together and sold to investors. On paper, it spreads the risk. In reality, It obscures it. You can't see which mortgages are good and which are toxic. You're buying a black box. And the ratings agencies, Moody's, Standard & Poor's, Fitch, they slap AAA ratings on these CDOs like they were handing out participation trophies. Why? Because the banks creating the CDOs paid them to rate them. That's not a conflict of interest. That's a conspiracy. And then there were credit default swaps, essentially insurance policies on those CDOs. If the CDO failed, the swap paid out. But here's the kicker. You didn't need to own the CDO to buy the insurance. You could bet against mortgages you had nothing to do with. It was like buying fire insurance on your neighbor's house and then handing them a gas can. By 2007, the credit default swap market was $62 trillion. The entire U.S. economy was $14 trillion. You do the math. When the housing market collapsed, it wasn't just homeowners who lost. It was pension funds, insurance companies, entire countries. AIG alone required a $182 billion bailout because it had sold credit default swaps it couldn't cover. But here's the part they don't want you to know. The people engineering these products, the traders, the executives, the lawyers, they knew. They had emails, internal memos, risk assessments showing the whole thing was a house of cards. And they did it anyway, because the incentives rewarded short-term profit over long-term stability. Bonuses were paid on deals closed, not on outcomes. By the time the bomb exploded, the architects had already cashed out. You won't believe the names involved. The receipts are wilder than you think. But before we get there, you need to understand what happened after the collapse. Here's how the $10 trillion transfer actually worked. And yes, $10 trillion is a conservative estimate when you account for lost home equity, destroyed pensions, evaporated wealth, and the long-term GDP losses from the Great Recession. Phase 1. The setup, 2000 to 2006. Interest rates were slashed after the dot-com bust. Money was cheap. Banks needed somewhere to lend it. The housing market became the target. Subprime mortgages, loans given to people with bad credit, no income verification, adjustable rates designed to explode, flooded the market. By 2005, subprime loans accounted for 20% of all mortgages. That's $600 billion in loans that never should have been made. But the banks didn't keep those loans. They sold them, packaged them into CDOs, got them rated AAA, and sold them to pension funds, foreign governments, insurance companies. The fraud was systematic. Countrywide Financial alone originated $1.4 trillion in mortgages between 2005 and 2007, many of them fraudulent. The legal term is predatory lending. The accurate term is theft. Phase 2. The amplification, 2006 to 2007. This is where derivatives turned a housing crisis into a global catastrophe. Remember those credit default swaps? Wall Street traders realized they could bet against the housing market using them. Hedge funds like Paulson and Company made $15 billion betting on the collapse. Goldman Sachs created CDOs specifically designed to fail, sold them to clients, and then bet against those same clients using swaps. In 2010, Goldman paid a $550 million fine for this. No one went to jail. The fine was 4% of their 2009 bonus pool. But it wasn't just greed. It was structural. The shadow banking system relied on overnight lending, banks borrowing from each other to cover daily operations. When Lehman Brothers collapsed on September 15, 2008, that trust evaporated. Banks stopped lending. The credit markets froze. Companies couldn't make payroll. The real economy seized. Phase 3. The bailout, 2008 to 2009. The Federal Reserve and Treasury Department responded with the largest wealth transfer in human history. The Troubled Asset Relief Program, or TARP, authorized $700 billion in bailouts. But that's just the visible part. The Fed secretly loaned $16 trillion to banks through emergency lending facilities. Information only revealed years later through a congressional audit. Who got the money? Citigroup, $2.5 trillion. Morgan Stanley, $2 trillion. Merrill Lynch, $1.9 trillion. Bank of America, $1.3 trillion. These weren't loans in the traditional sense. They were below market rate, risk-free infusions that allowed insolvent banks to pretend they were healthy. The official story was saving the economy. The reality was saving the executives who caused the collapse. Not one major banker went to prison. Not one. Meanwhile, 10 million Americans lost their homes to foreclosure between 2007 and 2016. Median household wealth dropped by 35%. A generation of young people entered adulthood with no jobs and crushing student debt. But the banks? By 2013, they were more profitable than ever. The six largest banks went from holding 17% of U.S. financial assets in 1995 to 67% by 2015. Too big to fail became bigger and more fail-prone. Phase 4. The moral hazard, 2010 present. The Dodd-Frank Act was supposed to fix this. Stress tests. Capital requirements. The Volcker rule banning proprietary trading. But the law was gutted before the ink dried. By 2018, Congress rolled back key provisions for banks under $250 billion in assets, like Silicon Valley Bank, which collapsed in 2023 in the second-largest bank failure in U.S. history. And the derivatives market? It's now $600 trillion globally. That's 7 times the entire world economy. Collateralized loan obligations, CDOs by another name, are booming again, this time backed by corporate debt instead of mortgages. Private equity firms are loading companies with debt, extracting fees, and leaving bankruptcies in their wake. Toys R Us, Sears, Hertz. The playbook is the same. The scale is bigger. The transfer wasn't a one-time event. It's a permanent feature of the system. Quantitative easing, the Fed's post-crisis policy of buying bonds, added $4.5 trillion to its balance sheet. That money inflated asset prices, stocks, real estate, fine art. If you owned assets, you got richer. If you didn't, inflation ate your wages while your rent doubled. The wealth gap between the top 1% and everyone else is now the widest since the 1920s. The last time it was this bad, the Great Depression followed. This is parasitic finance, a system engineered to extract value from the real economy and concentrate it at the top. The complexity isn't a bug. It's a feature. As long as you don't understand derivatives, shadow banking, and collateralized debt, you can't fight back. You can't even see the crime scene. Here's the nightmare you need to understand. The system today is faster, more interconnected, and more fragile than it was in 2008. High-frequency trading algorithms execute millions of trades per second. A glitch can trigger a flash crash. Private equity owns your hospital, your apartment building, your local newspaper. When the next crisis hits, and every economist agrees it's a matter of when, not if, the contagion will be instant and global. The Federal Reserve has already shown its hand. In a crisis, it prints money and bails out the rich. Your savings lose value. Your wages stagnate. But the executives who engineered the collapse get golden parachutes and consulting gigs. The game is rigged, but only if you keep playing by their rules. The lesson here isn't just about 2008. It's about denial. We want to believe the system works, that regulators regulate, that markets self-correct, that justice exists for the powerful. But 2008 proved otherwise. No one went to jail. The banks got bigger. The derivatives got more complex. And the next generation is being set up for the same slaughter. Only this time with student loans, credit card debt, and gig economy precarity instead of subprime mortgages. The hidden Constitution of America isn't written in parchment. It's written in credit default swaps, carried interest loopholes, and offshore tax havens. It's a financial system that privatizes gains and socializes losses, that rewards sociopathy and punishes prudence, that turned housing into a speculative asset and healthcare into a profit center. You can't opt out. Your money is in their banks. Your retirement is in their markets. Your debt is their asset. But you can see it. You can name it. You can refuse to accept the lie that this is natural, inevitable, or just how economics works. Drop a comment right now. Do you think we're wiser now, or are we just walking the same path in better suits? Share this video with someone who still believes the system is fair. Subscribe if you want the truth they won't teach in schools or report on the news. Because the next collapse is already being engineered. The only question is whether you'll see it coming. The elites are betting you won't. Prove them wrong.